Hello and welcome to Mortgage 101. This is basically a home buyer's guide through the basics of mortgage approval. So we'll be talking about the process, qualifying, types of mortgage, costs, and steps to take now. A mortgage is simply a loan that is used to buy your home. Unless you can pay for your home upfront in cash, you'll need to take a loan from the bank to pay the home off gradually. Just like any other loan, you'll need to apply for it. If you're approved, you'll be able to borrow a certain amount of money from a lender. Each month, you'll pay a portion of that loan plus interest for a period of time. The requirements to secure a mortgage may seem overwhelming, but understanding the basic lending terminology and requirements, you'll be able to avoid common roadblocks. Use this guide to learn how to prepare before applying for a mortgage and what to watch out for during the process to keep your mortgage application as simple as possible. All right, so let's just talk about the process. First, you would like to choose your lender, or you should choose your lender. You can actually shop around for the best mortgage, but if you're in contact with a great realtor like myself, they'll have a lender that they work with on a regular basis that they should be able to refer you to. Um, you'll want to ask them certain questions. And I do have another document for questions that you can ask lenders, but here are some of the common ones. What are your process for pre-approval and closing? How do you communicate with your home buyers? And what will my down payment requirement be? And let's talk about what fees are involved. Second step, you want to go forward with getting pre-approved for a mortgage once you've interviewed a lender. The lender will review your financial situation to determine how much they are willing to lend. Pre-approval helps you be taken seriously as a buyer. As you know, a lot of agents will, not show homes without a pre-approval, and rightfully so. If we are investing our time in showing you properties, we want to make sure you are serious about purchasing a property and able to do so. Knowing how much you can afford, having negotiating power, and you can actually speed up the loan processing time for a quicker and smoother closing with certain loans. What you want to do after you get your pre-approval is this is when you start house hunting. And house hunting consists of searching for homes, and you are in a position where you can make an offer for a property just because you are already pre-approved. Next step is going to be loan application processing. You'll fill out the loan application for the home that you are intending to purchase. The loan processor will create your file and request documentation from you. Once your home inspection is complete, the lender will order the appraisal for your home. Also, there is a step called underwriting and approval of closing. Now, as crazy as this sounds, you're not fully approved for the loan until a couple of days before closing. So basically what happens is the underwriter analyzes the loan to determine if it can be approved, and you may be asked for additional information. It can be frustrating, but this is normal. They want to protect the assets that they're getting ready to lend out. So they're just, how can we say it, going through everything with the fine tooth comb to make sure this loan product and you will be a good fit for each other so that you can purchase your home. Qualify for a mortgage in today's market. So here are a couple of tips. First and foremost, you always want to check out what your credit score is. A credit score can be between 200 and 860. But an average credit score of about 620 is best for trying to obtain a mortgage. You can improve your credit score by paying down credit card bills and not charging credit cards to the max. And if you wait 12 months after credit difficulties to apply for a mortgage, the time does kind of ease the possible credit issues. And then once you do that, you're basically ready to shop for a mortgage. Just don't open up any new credit card or loan accounts during the process. Determine the determine the approximate amount of the mortgage you may qualify by taking your gross monthly income and multiplying that by 25%. This is the maximum that many lenders would like to see for your monthly mortgage payment. You want to make sure you have stable income and you're able to verify that income. Both are very necessary going through this process. So make sure to stick with your employer while going through the home buying process, as if you switch jobs, it'll kind of make the lender have to reevaluate your finances. So you want to have that stability there. Here are some types of financing. Conventional loan, which is considered creme de la creme. This loan kind of says it without saying it, but it lets sellers know that you have a pretty high credit score and that you are kind of good with saving money. Sometimes this loan has been associated with a 20% down payment so that you can qualify for the best rates without mortgage insurance. But there are companies who have pretty unique conventional loans where 20% may not be the standard. Conventional mortgages are not guaranteed or issued by the federal government. And this is one thing that sets them apart. They don't come with a lot of rules and regulations on what you can buy and how long you can stay there. Second type of loan is FHA. This is a government-backed loan sponsored by Federal Housing Administration. If your credit score is too low to qualify for conventional, you'll likely use an FHA loan product with a minimum down payment of 3.5%, and it would require mortgage insurance, which is an additional fee that, because they kind of feel like they're taking a risk on you, they want to make sure the mortgage itself is insured. Veterans loan. This loan is for active duty military veterans. The U.S. Department of Veteran Affairs backs this loan instead of a traditional bank. Most VA loans do not require a down payment and offer several other advantages. Cost. This is a big one. So your earnest money deposit is typically 1 to 2% of the purchase price. This deposit is made by the buyer and it's held by the escrow company as a good faith gesture to the seller from the buyer. At closing, the earnest money will be transferred to the seller as a portion of the original purchase amount. Honestly, I've always seen the earnest money be applied to the buyer side. Then there's the down payment if it applies. This is a portion of the price that you'll have to pay in cash or bring at closing. The rest of the payment is made to the seller from your mortgage company. Down payments are generally anywhere from 3.5% up to 20% of the purchase price, and a down payment with at least 20% allows you to avoid private mortgage insurance because you're basically investing in yourself and that money goes back to you. Closing costs are associated with your mortgage, the transaction, and any payment required to the lender, such as taxes, insurance, and title fees. These costs are not a part of the purchase amount, and they are collected separately by the same escrow company at closing. So as a buyer, you can expect to pay about 1 to 5% of the purchase price in closing. So these are 3 separate costs that happen throughout the process, but down payment and closing costs is typically at the end of the process. What's in a mortgage payment? Principal of the loan. This is the amount that you borrow and it's also referred to as the amount financed. Then there is interest of the loan, the amount the lender charges you to borrow the money. That's very important that you understand the interest rate that you have. Property taxes. A portion of your payment will be used for property taxes to your local city. Homeowners insurance, the amount you pay to insure your home from damages, fire, natural disasters, etc. Also, consider your payment for private mortgage insurance if you happen to go into a FHA loan. And that's usually required if your down payment is less than 20%. Terms to know: fixed mortgage rates, adjustable rates, annual percentage rate, and mortgage points. I'm going to let you take a few moments to review these, and you'll always have this document to refer back to as well. Track your monthly budget. This is so important because when you purchase a home, it kind of makes you conscious of the money that you are spending. So just be kind of mindful to track your monthly income, and you should do it even before you're purchasing a home so you can see where your money is going. Steps to take now. Before you begin the mortgage process, it's important to have your financial plan for purchasing in place. Use your track monthly budget to save for a down payment, reduce debt, and increase your credit score. It's also crucial that you take extra time to search for the right lender and the right loan. Check references, shop around, ask plenty of questions, including an estimated a fixed cost for the mortgage. Your lender will inform you on the documentation you will need. However, you can begin preparing for that by knowing these are the documents that they're going to ask for. They usually ask for about 2 months of recent paycheck stubs. They also ask for your two most recent years of tax filings, 3 months of bank account statements, and finally, make sure to respond quickly to the paperwork that your lender actually requests from you, because we have this thing in real estate called time is of the essence. So we have deadlines and due dates that we have to meet, or else we are reprimanded by things of that nature. Now that you have the basics down, you are all set for a seamless mortgage approval. Thank you for taking this time out and watching this video today. I hope it was very helpful. If you have any other questions or want to reach out to me, pull out your smartphone, take a picture of this QR code. It'll take you right to my website. And if you haven't or don't already, my number is 757-831-0759. And my email address is Shonda@yourrealestateconnect.com. Thank you.